What's up, YouTube? This is your girl Jay back at it again with another Life Hack 101 video. I was asked quite recently, actually, I think a day or two ago, about what is investing. So this video is going to cover some of the basic concepts around investing and why you should do it earlier than later, and some of the different types of investing choices that you actually have out there. Some you already are investing in, and others you might not have known about. So my goal here is just to give you a brief overview of what investing is so that you will be more informed for our later videos where we actually go into some of the actual hacks that we will use to actually invest. Okay, so here's a background, and we are going to begin our lesson with investing 101. All right, so like I said, we're going to cover what investing is, what is compounding, okay, should I invest and save at the same time? Okay, so some people think, oh, well, I have a savings account, or I have a piggy bank, or I have a money roll in my pocket, or I save singles, whatever. And some people say, oh, well, I just have, my investment accounts. So we're going to talk about, if you should do both. Okay, how much should you save? And where should I start? So the where should I start part is actually the end of this video, but it is actually the beginning of several other videos. And for that, you'll definitely want to subscribe and come back to the channel to see the starting points on some of those investment choices. Okay. All right. So let's talk about what investing is. It is the act of committing money or capital to an endeavor. Okay. Basically, you're giving your money up for something that you expect to make money on. That's the simplest way that I can put this definition. So you have the expectation of gaining an additional income or profit. Okay. Some of you might be a little scared, and that fear comes in. Well, I could lose some money. Yeah, you can lose money. You can also lose money if you kept your money in the bank. You guys heard of the Great Depression? Well, that actually happened where, when the Depression fell and the markets fell, people had their money in the bank. And they all made a run on their money. And what that means is everybody went to the bank at the same exact time to withdraw all of their money, and the banks ran out of money. So yes, that can happen as well. You could also risk losing your money by keeping it wadded up in your pocket and it fell out. I remember one time I walked out of $200. Don't know where it is. Somebody had a very good day. So what I'm saying is there's always a risk when you save or invest. And if you make smart choices, about where you place your money and how you invest and how you save, then we start to minimize those risks. So anyway, I don't want to get ahead of myself, but just to say that investing is a goal-oriented thing. You're giving your money up in exchange for an income or profit. Okay. So this is probably the most important part of the entire video because this describes compounding. And if you all know about compounding and you are using compounding, then you are ahead of the game. Okay. If you don't know what compounding basically occurs when you have those investments. Okay. And those earnings start to add up over time. So as your investment gets larger, it has the potential to grow faster. Okay, so let's look at this example of compound savings at 8%. What that means is that's how much growth you're going to have. So whatever, take your dollar. If you're investing $1 and you think you're going to get an 8% return, you would just multiply that dollar by 8%, which would be 8 cents. So you would have $1.08. Okay, so this is just assuming an 8% rate on however much money they're contributing. So we're looking at 3 different people. We're looking at Aaron, Bob, and Carl. All right. So Carl, at 20 years old, he saves $2,000 for 10 years. Okay. So total out of pocket, he has saved $20,000 in 10 years. Okay. Bob begins saving at 30. He also saves $2,000, but this time for 35 years. And he's managed to set aside $70,000 of his own money that he has saved over that time. And then we're looking at Carl. Carl began saving at age 40. He saved $2,000 for 25 years. Okay. Now, what this line graph represents is the amount of money that they all have attributed or compounded over time. So the green is Aaron, and Aaron actually, by setting aside $20,000 at the age of 20, less money than Aaron and Carl has managed to save up through compounding $500,000. Okay, Bob was able to save up through compounding about just under 400,000, and Carl saved up about 175,000. Now you're asking, well, why? How is that possible if Bob and Carl have contributed more money over time? And the answer is that it's time. Aaron started sooner. Aaron had more time for that money to grow and compound on itself. Okay, so should you definitely start saving if you're Bob and Carl? Absolutely. But if you're Aaron, compounding really becomes, crucial for you. Okay, so Aaron, all the Aarons out there that are 20 to 27, you'll want to definitely go ahead and just start saving whatever you can. If it's $50, if it's, $10 a week, look at your income and then you make that determination, because the compounding really is going to be a factor. And I guarantee you, if Carl knew what Aaron knows now, Carl would have started saving and investing at 20 as well. Okay. All right. So these are all different types of investments. We're not going to cover them. Some you may recognize, some you don't. But these are common ones that you do come across. So you have stocks, bonds, investment funds, bank products like your checking and your savings account. So, hey, if you have a checking or savings account, you're already investing. Because if you don't know, your savings account at your bank will actually give you an interest rate. It's very low. Most of them are very low. You might get anywhere from 0.01% all the way up to 2% or 3% over the year. Okay, so keep that in mind. You can gain interest by having money in a savings account. Then you have options, which are contracts that allow you to buy 100 stocks at a certain price. Options is a whole nother entity. I would suggest you not go ahead and start investing in options until you have studied several courses, because a lot of people, not me, but a lot of people would say options are kind of like gambling. So that's basically a more advanced thing. But yeah, so that's a type. You have annuities, which are contracts that through insurance companies that will actually pay you monthly, a monthly check every month. It could be a deferred annuity, meaning you would start getting those payments after you retire, or you could pay in to start receiving them, in as little as 5 to 10 years. You have retirement investments like your 401k, your IRAs, your Roths, and things like that. Those are all retirement investments. So if you're already working for a company, and your employer has a 401k and you're participating, guess what? You're an investor. Okay. Saving for education. There are what we call 509 plans, and those are the plans that they take out of your check, or you contribute monthly towards the price of college. And over time, that account begins to accrue interest and it compounds on itself, kind of like that Gerber Life Baby. I might be too young to remember, but there used to be I think it still is, the Gerber Baby Life program, where we'll like grow with your baby or whatever. And what they're talking about is, hey, we're going to start compounding at a baby's age. So from year one all the way up, it's just taking in more time for that compounding to really take effect. Let's see, where are we? Cryptocurrency. So that's your Bitcoin. And you guys have all heard about Bitcoin. So yeah, you can actually invest in Bitcoin. Real estate, buying property, that's an investment. Commodities like buying gold and silver and oil and actual physical products. You have security futures. That's your futures index. So that's you buying into like a long-term plan, and then you will get a return on investment. And then you have your other insurances, like your medical insurance, your life insurance, your whole term life insurance, so all of those different insurances are actually types of investments. So the question is, should I invest or save? And the answer is both. Okay. So you should have at least 6 months in emergency savings. Okay. So what do I mean by 6 months in reserve? I mean, take your expenses. Okay. And you should have about 6 months of those expenses. So your rent, your, everything that you would need to have for 6 months, your cell phone, your utility bills, your groceries, your gas, figure all that out. And we have a life hack video coming for that as well. But once you tackle those expenses for the month, you multiply that by 6 and you say, hey, you know what? My emergency fund might need to be about $5,000 or $6,000, or it might need to be $500 if you're living with your parents. Okay. So, it just depends on what your personal expenses are. So yeah, you should definitely have a savings account, and you also should have in that savings account, or even a separate account, and we'll talk about that later, goals. All right. If you want to buy a car, if you want to, buy a house, all of these goals, take a vacation, get a new wardrobe. These are things that you should definitely save for. Okay. We don't want to rob Peter to pay Paul and get into the whole credit card game, which I know a lot of you have done. I've done it myself. But again, this is if I knew what I knew then, what I know now type of thing. Okay. So you definitely want to be able to budget and put aside money for the things that you want, need, and your future goals. And then for your investment, if your employer offers a 401k, you need to take advantage of it, because what they will do is they will match you up to a certain percent. So if you put in $100, your employer will match you $100. Okay. So you need to find out what that match is. I believe like mine it's 100% up to 5 or up to 50% of what it is. So in other words, if I go above, if I make, I'm saying this poorly. Okay. If I contribute $100 in my 401k, every percent, that is what my employer will match up until 50% of that. And I am saying that extremely poorly. But what you want to do is definitely, if your employer is going to give you up to 5% match, then you definitely need to contribute up to the 5%. So whatever your employer is giving you towards your percentage, you want to at least start there. Okay. So don't just say, oh, I'm just going to do 1% of my paycheck or 2% of my paycheck. No, you want to do whatever your employer is matching. And then over time, go ahead and increase that another 6 or 7% until you're comfortable. And you know what? You won't even miss it. Comes right out of your check. It's tax deferred. So you're not being taxed on contributing to your 401k. You don't miss it. That's all. I like to say, after your expenses or everything is paid for, it's all play money at the end. So, just make sure you take care of your business up front, and then everything left over, your A1. So your 401k is taking care of business up front. Okay. You also have your IRAs and your Roth IRAs. Those are probably going to be outside of your employer for the most part. So you'll want to go ahead and look to see if that's something you want to do. So an IRA is a little bit different than a 401k. An IRA, you can actually pull the money out because you're being taxed on that money. Okay. As soon as you take that money out, they're gonna take whatever the percentage of the tax rate is right then and there. So that means that you can actually use your IRAs a little bit quicker and not penalized like you would be if you withdrew early from a 401k. So you can actually contribute to both at the same time. You can have a 401k and you can have an IRA. And then you have your investments. So you can buy stocks, you can buy bonds, you can buy, a combination or buy a real estate property. You want to buy the house next door. You can have those investments because, again, what's the purpose? You're looking to get some of that money back as a profit or income. Okay. Me personally, I've just gotten into the dividend game, which that's me buying stocks that are going to pay out just for owning the stock every single month. So I have a portfolio of just stocks that are dividend stocks that will actually pay me money just for owning them. So how cool is that? And we'll get into all the dividends. And guys, don't worry if there's something that is a little bit unclear. Please let me know in the comment section below, and I can address those in future videos. Okay. All right, so all this being said, where should I start? So the first thing that I would do is start with your savings. Okay, if you don't have a savings account, you need to open one. Okay, it's important. And you should probably do it where you have your checking account if you don't have a checking account. Okay, if you don't have a checking account or you don't have a savings account, you need to be going to the bank right now, because your bank also has different benefits from using their institution, because you could go to any institution, right? You don't have to just stick to the one that says, hey, you should come bank with us. You should definitely shop around. And one thing that you'll want to do is ask them, hey, what is the interest rate on my savings account? And they're going to look at you like, oh, you care about that sort of, because I'm telling you, most people don't ask about that. How much interest am I going to get in my set? Because if Ally is going to offer me 4% and Chase is offering me 0.1%, you make that decision yourself. And then you have micro investing, which is another way to save your money. And how that works is like a application like Acorns, it will round up your purchases using your card to the nearest dollar. And then that goes in a separate account. It's not going to your bank. It's actually in Acorns, and it's FDI insured and all that good stuff that you want to hear. So it's legit. But it will round up your change. So if I went to 7-Eleven and I bought a Slurpee and the Slurpee was 98 cents, it will put aside 2 of those cents into my Acorns account. Okay. And it will do that on every single time I use my card or I pay bills or I do anything like that. It'll round it up. And then what it does is it will take those rounded up pennies, those cents, and it will then invest in actual investments. Okay, so you will actually own stock just from your change and you not even noticing the money. Okay, so that's pretty awesome. And Stash is another application that's kind of similar, and I'm gonna leave links below. If you decide to sign up with Acorns, you get, I believe it's $20 and I'll get $20 or something like that. So if you want to do that, you can definitely do that. It doesn't cost anything to get started with Acorns. It's totally free. You will have to link your bank account, so don't be shocked if they're like, log into your bank account, because it has to have that in order to get the money from your change. Okay. And then Capital is cool. I actually started using Capital about 4 years ago, and it will round up as well. But Capital does a different thing. Capital kind of works more for goal setting, because it lets you say, hey, I want to go to Hawaii, and this Hawaii trip is going to cost me $5,000. So it will actually track, how close you are to that goal. It doesn't invest your money. It does have some kind of return on interest. I think it's low. It might be more than your bank account. But it's still kind of low because you're not actually investing in stocks and things like that. So if you're just looking to do savings only and you're in the whole idea of investing at this time scares you, but you still want to be able to save using your change, then definitely go over to Capital. Investments. I have used Robinhood for a few months now, and I like it. I like the simplicity of it. You can go on Robinhood and buy Foot Locker, you want to buy Facebook or whatever the case may be. Robinhood lets you basically buy and sell. Okay, so those are things that you actually have to manually go in and do. You have to, you can find different stocks that are like under $15, and then you can buy them and then you can sell them. And it's really simple on how to do that. I think I own, I don't know, maybe 30 stocks, and they're all managed on Robinhood. And I'm gonna have a Robinhood video, an actual walkthrough guide with my youngest, Alicia. She's going to actually be setting up a Robinhood account. So if you want to check that one out, check back in a couple days, and then I will have that one for you. So Robinhood is just basically the app where you can buy and sell stocks. Okay. And then you have the dividend paying ones. Okay. Now I can buy stocks that pay dividends on Robinhood. And actually I have most of my stocks on Robinhood actually pay dividends. But let's just say, hey, you know what? I actually want to own Facebook, but I don't have $135 to buy one stock in Facebook. Okay. That's called micro investing. Maybe you have $10, maybe you have $15. You can, with M1 Finance, buy many different stocks with a certain amount of money. So it doesn't matter what you're purchasing, it just matters how much of a percentage you want to buy based on how much you're contributing. So M1 Finance is a great set it and forget it, where you don't have to go into something like Robinhood and scour and try to find stocks that are in your price range. You just go ahead, you've already pre-selected the stocks that you want to buy, and you say, hey, I only have $100, or hey, I only have $25, and then M1 Finance will disperse them. Will disperse all of those different stocks that you've pulled in, and that's what's called micro investing. So you're not purchasing the entire stock, you're purchasing a percent of what you can afford. Okay. And then over time you will then be able to actually own the stock. But this is a great way to just jump in the game without needing to actually have the entire amount of money for those stocks. Okay. And then we talked about 401ks. So you definitely want to get with your human resource person at your job, and they have all the specifics about getting you set up, or maybe you don't even know what you're contributing. You don't know how to read that on your check stub. I mean, your human resource department is where you go definitely for that. Make sure you get your login, make sure you understand the platform or the brokerage or what you're using, so you can track your money. Okay. And then an IRA, like I said, this is something separate than a 401k. This is one that you can, like I said, pull money out of a lot faster because it is taxable. All right. So they treat it differently than a 401k because it is. Your 401k is strictly retirement, right? And you do have Roth and the straight up traditional IRAs, but the penalty isn't as much as if you were to take out of a 401k. So definitely look into some of the brokers. You got your popular ones like Fidelity, Merrill Lynch, TD Ameritrade. You've got them in spades, and you can contribute to that in a lump sum. Maybe you want to take your taxes and dump them in there and have them grow interest. I mean, I don't know. I think the IRA contribution limit is $6,000. So that's the max that you can put into that. And I mean, that I know that seems like a lot, but some people out there have $6,000 that they can just pop in. But that's the limit of how much you can put in. So I mean, $50 here, $20 there, or if you set up automatic disbursements, then that account begins to grow faster as well. So I said a lot. Again, this was just an overview of investing concepts in general. All of these might not strike a chord with you. There's no right or wrong way to do it. And if somebody says, oh, you need to just do this, that works for them. Okay. And it takes time for you to kind of develop your own system to say, hey, what type of investor am I? Am I a casual investor? Am I an active investor? Am I a dividend only investor? Am I a real estate investor? There's different ones out there, and you can just be a combination of all. You can have different accounts, different investments for different purposes. Maybe you want to use M1 Finance, grow your dividends there, to be able to pay for, I don't know, your karate lessons every month. You could do that as well, just by having your money in those dividend paying accounts. So yeah, we're going to get into all of those. And these will be different videos. I intend not to make them as long as this one, but this was a great place to start as an overview. So I really thank you guys for watching, and hopefully you guys got something out of this video. And if you have any questions or comments, please feel free to use the comment section. That's there for you. And yeah, don't forget to like and subscribe, and we will see you next time, hackers. Class dismissed. Hey guys, thanks for watching another great Life Hack 101 video. If you liked what you saw today, please click the like button. And to get even more great content from Life Hack 101, go ahead and subscribe to our channel. See you next hack.